You're listening to the Wise Women Invest podcast, a division of Noise Media Network, hosted by Audrey Bell Kearney. Wise Women Invest is on a mission to help 1 million women learn how to make smart money moves by becoming savvy investors in real estate, the stock market, cryptocurrency, and early-stage businesses. Now your host, chief noisemaker, and wise woman herself, Audrey Bell Kearney.
Welcome, everybody. Welcome to another episode of Wise Women Invest. We're here with Carolyn Shoemake talking all about investing. And so this is going to be probably like a 5 to 6 part series. Because we want you to understand, when it comes to stocks, mutual funds, bonds, annuities, variables, it's so many things. We want you to understand before we get into the deep side of investing what these terms mean. So we want to make sure that you know what the terms mean, so that way when it's time you invest, you can make the best choice for yourself. So we're going to kick it off tonight. Carolyn's going to be sharing with us what is a stock. What's the difference between a stock, a mutual fund, a bond? But we're going to talk specifically tonight about stocks and how to read a stock ticker. I remember a long time ago, Carolyn, I'm not going to even tell people when because I'm going to date myself. But a long time ago, I was working at Prudential Insurance Company, and they sent us away to a weekend called, they had an organization at the company called Minority Interchange. And this was an organization inside Prudential where they wanted to make sure that, minorities, it was almost like, what can you call it? Well, it was a program inside the company where they wanted to make sure that minorities got the training, the understanding about things that we weren't normally have privy to, right? Mm-hmm. So they sent us away for a weekend. And when they sent us away, this is when I learned about stocks a little bit. They sent us away. There was a woman there giving a presentation about stocks. And I thought that was the most intriguing presentation. Like, nobody wanted to leave the room. Everybody wanted to stay there because she was talking about stocks. And this was like 1997. And she taught us how to read the Wall Street Journal, which I thought that was amazing. She taught us what a ticker was, because we didn't know what that meant. And so I want to be able to share that same information tonight with our viewers so they can understand what a stock is, what's a ticker, how to read a ticker, and what to look for when trying to find the best stocks for your portfolio. So thank you for joining me. I know you are a busy woman, and I appreciate when you come on here on Wednesday nights with us and talk about money. I know some people like, that's fine. I'm gonna put the kids to sleep because you're gonna be talking about money. But for some of us, it's like, oh my God, I gotta talk about money and I'm tired. So thank you so much for coming on and sharing with us.
Well, I'm glad to hear that you have actually you've actually been to some of the sessions on stock. Because you could probably talk to me a little bit about some of the things that you've learned as well. Because one of the things that I've always shared with people is that you always want to get understanding. Get understanding, and that way you know exactly what you're doing when you decide to make a decision to actually get involved. I'm really glad you're doing these sessions too, because it's really going to be about all of the things that a person needs. When we say Wise Women Invest, it's going to be about everything. It's going to be the market. It's going to be making sure that you can free up money to save. It's going to be in all of the different types of vehicles that a person can actually choose to start investing in. So a stock, very simply, is ownership in a company or buying shares of a company. So when an organization decides to issue stock, and normally that's typically when they decide to go public. When they decide to issue stock, that is their making an attempt to raise money. And so when they sell stock in a company, they're doing raise money so that they can take care of all of the things that are happening in the company. So the stock is simply a person it's a type of security where you have a fraction of the company. So when we think about a lot of misconceptions that happen a lot of times is people think that, okay, I own the company if I own some stock. Well, not really. And that's kind of a misconception that people have. When you own shares in the company, you're actually owning just a percentage of it. And let's think about some of the companies that are doing really well right now, because when you make the decision that you want to buy some stock, then you want to look at companies that have really great track record. You want to look at companies. Warren Buffett says, and you guys know who Warren Buffett is, that when you look at making a decision to buy stock, you should look for what company, what's their performance, what are they fundamentally, what are they all about, what is their debt to equity ratio, and that means what is that company's, and you can find all of this out when you do your research, that you're finding out what their debt to equity ratio is, and that's basically the liabilities that that company has. And then one of the main things you want to find out is what is the future potential. So when you own stock and you make that decision that you're going to buy stock, typically when we talk about stock, most people are buying what's called, and stock comes in basically two shares: common shares and then preferred shares. And most of the shares that individuals purchase, and when they're talking about buying stock, it's common shares, which means you get to vote. You'll get a letter that says this is going to happen. You get to vote on the people that are the board of directors. But basically, you and different from preferred stock, you really don't get, like, if the company decides to issue a dividend, the common stock people are the last ones to get that dividend. The preferred stock people get it first. But typically, it's simply ownership in the fraction of a corporation. And that does not give you can't go somewhere and say, I own McDonald's or I own Facebook. That's not the case. You simply own a fraction of a share of the company. So you actually own shares.
What's nice about that, Carolyn? What's nice about being able to say, I know we want to say we own the company, but if you own some shares in a company, that still could be very lucrative depending on when you got into the company, because that's another thing. Like there are so many, like right now. So back in 2012, President Obama, he released something called the Jobs Act, and the Job Act had a whole bunch of different components to it. But one of the components that got my attention was the fact that now a small company like my company could actually put offer equity in my company through crowdfunding, and it's called Equity Crowdfund, but it's crowdfunding, and that's pretty cool. Now I got excited about that for two reasons. One, I could sell equity in my company as a crowdfunding on a crowdfunding campaign, which allowed me, because right now, think about Kickstarter, right? If you set up a Kickstarter campaign, or if you set up an Indiegogo campaign, you can give people perks, you can give them trinkets, you can give them shout outs, t-shirts and things like that. But you can't give them equity when you do crowdfunding and Kickstarter or Indiegogo. But if you use something like a WeFunder, you can actually sell equity in your company. So I got excited about that part, because at that time I was looking for money for my company. So I was like, okay, when they kick this thing off, I need to have everything in place. So 2015, it actually became a law. Now you got a company, you want to raise some funding for your company, you can sell shares in your company through crowdfunding. And when I started to look at it, I was like, okay, this sounds great, but it's going to be so many so many shareholders in my company. Like, do I really want to be talking to all these people when they start buying equity into my company? And I was like, no, which I didn't. So that was exciting. But what was also exciting is that if you, the viewer, are looking to invest in startup companies, you can go to something like a WeFunder, and you can find campaigns and Start Engine, and there's another one called Start Engine. You can go there and you can find companies that's selling equity in your company, right? And you can get those shares for like a little bit of nothing, not like a McDonald's. You can get a fraction of a fraction of a fraction of a share from McDonald's. But for a startup company on Start Engine or WeFunder or one of those platforms, you have the opportunity to actually buy shares in a company. Sometimes one share could be $100. Now, here's the thing. You take a risk, right, Carolyn? Like, you can take a risk because you don't know if that company is going to make it. But just in case it does, you may have a full share at $100. So that's the one thing I could say about, investing in startups and things like that. Do your due diligence. We're not telling you who to invest in. We're just saying do your due diligence. McDonald's, right? A lot of people eat McDonald's. And I was told a long time ago, buy stock in companies that you like and love, like Nike. Like, buy some shares in Nike. Like, I have stock in, like I told Carolyn the other day, I have AMC stock, right? Because I go to the movies and I like to go to AMC. We have a beautiful AMC around by my house. It has like the You order the food, they bring the food to your seat. It has recliner seats. I love it. So of course I would have stock in that, and my stock did really well because remember, nobody was going to the movies last year, and so AMC stock dropped tremendously. And when it dropped, I said to my husband, "Oh crap, we need to get some of that stock." So let's talk about that, Carolyn. Like buying stock in the things that you actually love, and how do you go about doing that? Because I think a lot of people like, well, I like Nike, I like McDonald's, but I have no clue what. My brother called me. He's like, "Yeah, I just got some stock," and I was like, "What?" So I lost that deal, Carolyn. But there's nothing I could do because he's not a risky kind of person. So for me, it's like even when I used to talk about stocks, like, yeah, I don't want to do that. Now it's like I bought some stock. I'm like, you did what? So.
You know, one of the great things is that I'm glad you talked about that. A person has to buy stock through a broker, or there's so many online, which I don't typically recommend because I think it's important that you fully understand what you're doing. But there are a lot of online resources now where people can go and buy stock. The key is understanding what you're buying, knowing that if you haven't done it, because it's all risky, because we don't know. Now, the market has done so many things over time, but nothing can be guaranteed to you that your money is going to grow. So you definitely want to do your research. Having a broker, someone who's actually in the profession of assisting you in buying stock, and or using one of those online platforms can help as well, because it shows you at least some things that you can look and do some research and find things that you can afford, where you're actually buying full shares instead of fractions of shares. You can do that. One of the things that Warren Buffett does as well, Audrey, when we talk about buying stock and things that we know we use every day, like the AMC, I also own stock in AMC as well. But one of the things that I share with people is that look at acronym that I use called FANG, F-A-N-G, for Facebook, and we know that's changed to Meta. A stands for Apple or Amazon, N stands for Netflix, and G stands for Google, FANG, F-A-N-G. There are so many other companies out there, but those are companies that are mainstream America right now. Everybody knows what's going on with them. Unfortunately, their price per share is kind of cost prohibitive for the average person. So we know that some of the ladies on this call may already be, or who listen in to Wise Women Invest, may already have that kind of income where they can go in and actually buy shares like that if they want to. But there are so many other companies out there that the cost per share is not as exorbitant as the Facebook, Apple, Amazon, Netflix, and Google. Because Facebook right now is like $27 a share. That's just as of today. Amazon, that is $3,500 a share for Amazon. So you know whatever amount of money you allocate monthly is really only going to buy a fraction. There's some indexes that people look at sometimes when they're trying to think about the companies. So think about companies that have had historical, long-term, really great track record, like the companies that make up the Dow Jones. And that's a terminology that you guys hear every single day when you turn on your TV. It says the Dow Jones was this today, or the NASDAQ was this today. You know, those are indexes that have the companies in it that are mainstream America. So the Dow Jones has about 30 different companies that make up the mainstream America. So when we listen to the Dow Jones, just think that it's 30 of the companies that most of us know about. We know their ticker symbol, like deal, like what is Facebook? Facebook is, I think Facebook is F. I think I can't remember what Facebook is. Just
like FBK or something.
Yeah, I just had a Microsoft is MSFF. So Cisco, Coca-Cola is one of the companies on the Dow Jones. Walmart is one of the company. WMT is their ticker symbol that's on the Dow Jones. So those 30 companies that you and I know about, Audrey, that we've seen. So you want to do your research. You want to look at what the company fundamentally stands for. And then, of course, your budget, because you want to make sure that the money that you're going to use to invest is money that you can afford to lose. Now, granted, the market has done really well. Last 50 years, the market has done really well if you've invested in it. So we're not saying that you're going to lose, but we don't know that. You follow? So you want to make sure that you're investing discretionary income, that you've allocated that money to invest, and it's not something that you're going to need tomorrow, because you want to give anytime you invest in the stock market, you want to give your efforts time to compound. And it's not going to just grow. Sometimes they do. You may find something that is really happening right now in technology or in some new advancement, and the price per shares are relatively small. Then you'll be great if you get in, and next year or 2 years you double your money or you triple your money. That is great, and that can happen. But for the most part, you want to do some research on those companies, those things that are really happening, that are part of the deck, that are part of the Dow Jones, that are part of the S&P 500. That's another index that has over 500 companies that people look at to determine what's really happening in America, what's happening in the financial arena. What companies can I look at that I can add to my personal portfolio? And again, make sure it's done with money that you don't need tomorrow, that is money that you can afford to invest, because it's all going to be speculative. But over long term, you can really make money when you invest in the stock market. It's like investing in the American economy, in the global economy. You'll be able to do that and take advantage of that. And the other great thing about stock too is that when you invest, your money is making money so much better than just having your money in the bank. You're going to make money through interest, or if they pay dividends, and you're going to make money through what's called accumulation in the value of the shares. So if you bought shares of a stock for $5 today and it goes up to $10 tomorrow, great, you've made a profit already. So those are the ways that your money actually begins to double for you, so much different than if you had it in a bank, because a bank is going to pay you a small amount of interest. But when you're investing in stock, people are going to those places. The stock is going to go up. One of the companies on the Dow Jones is Home Depot. There's so much building going on right now. So Home Depot is a good stock to have. Now,
I don't have that one. Oh, I need to get that.
We're not making any recommendations. Let me say that again. We're simply educating you, so when you're thinking about it, that you're doing your research and thinking about companies that are fundamentally sound, that have a potential for future growth, and that you have monies that's discretionary, that you can invest in the market to have it grow for you.
It's so cool. I didn't even think about Home Depot, and I got to go back and look at the Dow Jones, because my goal right now is to diversify as much as I can. And although I do have Amazon, I think I have some Apple, some Disney, I don't have Home Depot, and I'm Walmart. Like, people love Walmart. I don't have Walmart either. So you and I have to sit down, and I need to put some things in place, because I'm thinking I'm doing all right. I'm like, wait a minute, I don't have Home Depot. Why don't I have Home Depot? And I know I was just in Home Depot like last month, like three times. So I should have Home Depot. McDonald's, I don't eat that much McDonald's. Every once in a blue moon, I might get a taste for a French fry. But Home Depot, we're always there. Always in somebody in my household is in Walmart doing something. So we should definitely have stock in those companies. I want to touch on something. You said they can make money through accumulations, dividends, and you said something else. Accumulation, dividends, and
that was it for the stock. The accumulation in the value of their shares. You're thinking about the mutual funds. But
okay.
And so we'll get to that on another episode. But in the stock is really, it's when they declare dividends or interest, and then the accumulation in the value of the shares.
So when you have stocks, right? And let's say, for instance, you need to get some. You got this money sitting up in your stock account, and you say, you know what, I really want to sell these shares, but I'm gonna get hit with the penalty. Do you actually get hit with the penalty, or do you not? Do you have to pay taxes on that money, or do you not?
You pay taxes on gains, capital gains, and I would refer most people to a tax expert with that. But the you do pay taxes on capital gains taxes. So it triggers a capital gain when you sell it and you're making a profit all off of it. There's no penalty per se. It depends on how you set up your account with your broker. If it's just you buying stock, then there's no penalty if you decide that you want to give it to somebody, or if you want to sell it. There's no penalty for that. But if you're trading and you have there's capital gains tax on profits, so you would have to declare that on your income tax return. But there's no penalty. Penalties come depending on the type of vehicle that you're investing in. So if you've earmarked something, if you set up like a Roth IRA or an IRA, and we'll get to those later, those types of things require you to get penalized because they are earmarked for retirement. But for the basic person who's just buying stock, then it's like it's an investment, but it's not. There's no penalties on it if you sell it, or if you take money out of, or if you say, okay, I'm going to gift these to my children. I'm going to give them some shares of stock. There's no penalty for that.
Okay. There's another misconception too. People are really leery. You and I were together on Monday, and you were trying to explain to the young lady why, having a portfolio outside of a bank account is important. And she's like, I don't trust stock. I don't trust it. I'm gonna lose all my money. That is something I hear a lot. I've always heard that a lot. And I think it's just because people just really don't understand. Now, you could lose it, but what happens to the stock, Carolyn, if it drops? Do the stock disappear, or does the stock sit there and you let it sit there until the price come back up?
It doesn't disappear. It changes in value if the market goes down. You follow? If people, let's say, for example, I was thinking of an example of a company, Amazon, was that Amazon? No, Tesla. Tesla had something going on about a month ago where something happened, and the next day their shares dropped. Now, the people who own shares in Tesla, they didn't run out and so let me sell all my Tesla. They held it until it came, because it came back up like about a week or so later. So when you own stock, you want to hold it. Yes, there are going to be fluctuations, but you don't necessarily lose all of your money until it just goes belly up. If it goes belly up, then yeah, you've lost your money, but that's kind of unlikely for most companies. They will have fluctuations, but actually losing your money and losing all of your money is really pretty slim. Now sometimes, but that's why I say you have to make sure that it's discretionary income, because if you're investing money that you need to live for your household expenses and it goes down, then you're going to be in trouble if you're using it for that. But if you're investing, know that there are going to be ebbs and flows. There are going to be times when the market is up, and there are going to be times when the market is down. And you want to make sure that you're not get squeamish when that happens. One of the best ways to really augment some of that, and we'll talk about that in another session, is really diversifying your portfolio, where you have some stock in there, but you also have some mutual funds, you have some bonds in there, and we'll talk more about those, because the more diversified your portfolio, the better your leverage whenever the market does go down. But a company would have to literally go belly up and totally out of business for you to lose your money. And so, yes.
I want to, because we're almost out of time, but I want you to tell people what they should be looking for when they look for a financial advisor to help them, because I think that's important too. I was and I can't call a name, and it's so funny because I was in a meeting. I wasn't in a meeting. I was somewhere, and there was a gentleman, and he was talking about, he was a financial advisor. And I was like, oh, really? So am I. And so he started naming, he named so many things, Carol. It was crazy. And I was like, is he really? So then I talked to somebody later, and they was like, child, don't listen to him. What should you look for when you go to look for a financial advisor? Because I know there are a lot of gurus out there right now. we're teaching you about all kinds of trading and options and puts and all kinds of things. And so you want to be careful. But what should someone look for when they're trying to find a reputable financial advisor to help them start to create a portfolio?
I would say the number one thing, Audrey, is what you do and what I've seen you do is find the number one thing that an advisor does is that they listen more than they talk. They ask questions and they listen more than they talk, and they have the client's best interest at heart. Because a lot of advisors, because we're required to have so much education, so much continuing education, so many things that we know, but knowledge without practical experience can sometimes make you give your clients too much. It's important that they understand the market, that they understand the basic information and how they're going to invest. So you're going to look for a person who's going to ask you questions, who are looking at your entire picture, what's going on in your whole household, and not just talk about the things that they need that for investing where you're going to get money, but to see what your entire financial picture looks like. This is a person typically that can do a full analysis, Audrey. They're not just talking about the investing, or they're not just talking, but they're looking at every single thing that household spends money on. Some experience, they should be able to tell you some of the experiences that they've had, what their credentials are, some experience they've had working with people over the years, and what they did for people, and actual success stories of what they've done. But again, the key is it is an individual that will ask you more questions and listen more than they talk. In your first couple of visits, they're going to know what your goals and dreams are, what you're looking for retirement, when are you going to retire, when you're going to be ready for that. And that's going to be different for every single person. And it's not a cookie cutter situation. Every single person's financial picture is different. And so the great advisor would make sure that they're treating everybody individually, that they know that they can find confidence in them, that is confidential, and that is customized. And those are the two things: confidentiality and customization geared directly to the client is so important when you're looking at a financial advisor.
I think too, Carolyn, I think that if you meet a financial advisor and they make you some promises that sounds too good to be true, 9 times out of 10 they're too good to be true. So be very careful about that. Yes, we all want that quick money, we do, but 9 times out of 10 it's not going to happen. So be very leery of anybody who comes to you and they say, listen, you can get this or you can get that, because that's not necessarily the truth, and you can lose your shirt because of that. So you want to make sure you want to make them see great info. Let me pop this comment up there. I like to pop the comments up. You want to make sure that that you don't fall for the okie doke. Don't fall for all that glitter, because all that glitter is not gold, and you want to be very careful about that. Talk to them, ask them questions. Carolyn shares, when Carolyn has sessions with people, she shares a lot of stories. I'm a storyteller. I love stories. This is why I do the podcast. And so she always has an amazing story to share, because she helps so many people, and she's teaching me to do the same. So, she doesn't know, but I'm always watching what she does. My husband is cracking up most of the time, because the her group me group is bouncing off the wall. Like the group me group is just going. But I've learned a lot about, this industry and just making an investment in myself. So anytime somebody come to me with a great idea or some kind of crazy scheme. Now, back in the day, Carolyn, before I knew better, because when you know better, you do better. I did a whole bunch of crazy stuff. I was like, they said it's gonna make money. I was like, I'm in. Put in $100, it's gonna get you 10,000 back next week. I'm in. And that's not what happened. So exactly. You want to make sure that person is not selling you some pie in the sky for real, and that, because you can lose it all, and there's nothing that you can do about it if you get caught up out there. So just make sure that you listen and don't fall for the okie doke. Whatever you do not do that. Don't do that.
Exactly. That's great tips, great information, Audrey. And the key is, as the person just noted there, is getting educated. And it's about you. It's about every single person It's individual. Your stock that you're going to choose may be different from what Audrey would choose, because everybody has different desires. And, I don't shop at Walmart, but I own Walmart stock, because every time I drive by Walmart, there are cars all over the place. So it's going to be different for everybody. Just that everything that sounds great isn't great. You want to do your investigation, get the education, and plug into Wise Women Invest. And our goal is to educate and to teach as much as we can.
And listen, I hope you guys enjoyed this episode. We'll be back next week. We're going to be talking about mutual funds. Yes, it's mutual funds, stocks, bonds, annuities, all of that. We want to get that part out the way. So when we kick off January 1, we're talking to you about investing, like really, really investing. But you need to understand the terminology first, so you'll know exactly what we're talking about, and you don't get lost in the whole conversation. It goes over your head. Then you feel like, I don't even understand what they're talking about. I don't want to invest. So we want to get that information out there first, so you can understand the terminology. January, we want you to be ready to kick off your portfolio. We want you to get your financial assessment done. Go to wisewomeninvest.co. I forgot to put up the little banner. Let me put the little ticker up real quick. Go to wisewomeninvest.co. You can sign up for a free financial assessment there. Put in the information there, and one of us will get back to you so you can get that assessment done. Get it done so you know exactly where your money is going, and then you know how to allocate money to your portfolio, your investment portfolio. So go to that website, wisewomeninvest.co. Now, if you want to be a part of our club, go to wisewomeninvest.club. We have a club that we're launching, and that's where we're going to be inside there talking amongst ourselves about investing in all types of things: stocks, bonds, mutual fund, crypto, real estate, businesses, all kinds of stuff. So go to wisewomeninvest.club and become a member of our community. So, Carolyn, I want to thank you so much for coming on again for another episode of the Wise Women Invest Show. I know that you're a busy woman, so I appreciate your time. Appreciate you take the time to educate our listeners and our viewers around the world, because it's important. One of the things I could say for a fact is that when you have investments sitting in an account and you need to get liquid money, just like through that whole pandemic, a lot of people lost a lot. A lot of people couldn't put their hands on money, but a lot of people had some great investment portfolios, and they were able to go liquidate some of that money, and they were able to skate through. Like, the pandemic hurt a lot of people, but for a lot of people it didn't. I can tell you right now, on my husband's job, they allowed them to take the money out and use it for things that they wanted to do at home. It was crazy, and everybody lost their mind. It's like, we could take the money and not get penalized because of the pandemic. So when you have money sitting in a liquid account like that, if some hardships happen, you can always go and reach out and take some of that cash out. So you need to understand how to do that without being penalized. And that's what we're going to be sharing with you every Wednesday at 7:00. So be sure to tune in next Wednesday at 7 p.m. Carol and I are going to be talking about mutual funds, so you can understand the difference between a mutual fund and a stock. Is there really a difference? So we're going to talk about that, but you got to join in next Wednesday to get that information. So, Carolyn, thank you again for joining me. I really appreciate you, and we'll come back and we'll do it again next Wednesday at 7.
Thank you. Good night.
Good night, everybody. All right, that's it, guys. Listen, I'll be back next week. Carolyn and I both. Until next time, make it a great day. Bye, y'all.
You've been listening to the Wise Women Invest podcast. Tune in daily at 6 p.m. for a new investment tip to help you make smart money moves. To learn more about Wise Women Invest and to join our community and investment club, go to www.wisewomeninvest.club. To never miss an episode of the podcast, download the Wise Women Invest app from the App Store and be sure to share the show with another wise woman. Again, our website is www.wisewomeninvest.club.